Payment Pulse, a podcast by Xplor Pay, a leading full-service payments provider.
Welcome to Payment Pulse, a podcast by Clearance by Xplor, where we have a goal of humanizing and simplifying the complex world of payments. My name is Steve, and today we are joined by two of our executive leaders here at Clearance by Xplor, and very soon to be Xplor Pay. With that said, we have Matt Morrow, the president of payments at Xplor Technologies, and Chris Ryan, our chief risk officer, both of which bring a combined 30 plus years in the payment industry, a variety of backgrounds outside of that as well. Really appreciate you both taking the time to join us on this conversation today. This one's been one that I know we've been talking about a lot, and obviously in the industry as a whole. But today's episode, we'll be discussing the topic of surcharging, cash discounting, and dual pricing for vertical SaaS providers. Lots to cover in this episode, so we're going to be breaking it likely into a couple different, pieces, parts, but we'll see how far we get with this episode today. I have a list of questions to kind of go through, but again, really appreciate you taking the time out of your busy days to join us on this call. But wasting no time, we're going to get into this kind of panel discussion. Feel free to chime in, each of you. I'm not going to direct these questions to anyone particularly, but whoever wants to jump in. There are some more risk-related questions that we'll get into that maybe we let Chris handle here. But starting it off, why are pricing models like surcharging, cash discounting, and dual pricing gaining so much attention right now from merchants and software platforms?
Yeah, I'll take that one. So when you think about a small or medium-sized business, they're looking at ways to control costs. The cost of acceptance is one that historically they've not been able to do much about. And as these alternative pricing programs have become available and better understood as to what the rules are, we see mass adoption in certain segments and in certain markets. The number one reason is just a business doesn't necessarily want to have to pay the full cost of accepting a card transaction, and so they're looking for ways to remove that.
Okay, great. Let's get into kind of some of the differences then between the three. Can you start by, highlighting the differences between surcharging, cash discounting, dual pricing, and kind of what that means and the nuances between each of them?
Sure, I'll take a stab, and then Chris can fill in the gaps where I might have gotten it wrong. Um, I think the easiest one to see and understand as a consumer is surcharging. So the idea is that when I show up to make payment, there's an additional cost associated with presenting a credit card for payment. Um, in this environment, the cost to um, the the cardholder or the consumer is higher, and that's a distinction in the rules you have to keep in mind. It also needs to be properly disclosed, and um, the the merchant or the business has a obligation for communicating that they're in a surcharging program, and that anybody presenting a credit card specifically should expect a surcharge. The amount is capped at 3%, so they can't surcharge any amount they want. You might see some businesses we've seen, especially in some municipalities like big cities and things like that, where maybe the restaurant's applying some kind of service fee model where they're charging a blanket percentage on all transactions. So regardless of tender type, whether it's cash, debit, or credit, that's not that can be confusing. It can look like a surcharge, but what we're talking about is an actual merchant that goes out registers with their acquirer and discloses to their customers ahead of time that they'll begin surcharging, and then they're only surcharging credit transactions, and they're only doing it by about 3%. But it's important that the cardholder experience is one that the price goes up. So it's $100 pair of shoes, and the 3% is on top of that. Um, that's maybe the best distinction. The other two are a little bit different. The idea being that with dual pricing, I think as a consumer, if you've ever done a road trip in the US, you've seen the big billboards for gas stations that have a particular fuel grade, and there's two prices, one for cash, one for credit. or debit cards. And essentially, what they're doing is disclosing the idea that there's different prices depending on how you're going to pay. It requires 100% disclosure. So every item that is subject to dual pricing needs two prices. And they have to be listed next to each other. Um, and the effect is still a higher price for a card transaction. The delivery of that is different. It's not just a capped flat fee on top of the card transaction. It can be what the merchant wants it to be, based on the competitive dynamics in their market. Cash discounting is essentially just taking the higher pricing from the dual pricing concept and saying all my prices are higher unless you want to present cash. I'll give you a discount if you present cash, and usually that's disclosed as a sign on the front door or at the register that says, "Hey, if you pay cash, you'll get a percentage discount off the total." In that case, though, the reason it's distinctly different than a surcharge is that the consumer's paying the lower price. They're seeing a discount for cash rather than a surcharge for card, which maybe mathematically sounds like a difference without a distinction, but from a rules perspective, it is very different. Chris, what might you add to that?
No, that's a great recap. I think the biggest thing also is signage, making sure that your signage is appropriate as a merchant. You've got it at the right places, at the entry points, at the register. Really, what it comes down to is cardholder disclosure. Making sure that if you as a merchant are going to display prices, you're displaying your higher of the two price, and that you're coming down off of that whenever you're implementing any program. Um, but yeah, it's disclosure is important.
Yeah, yeah, that's a great summary and a great addition there. I know the signage piece is critical, so appreciate that additional insight. Um, I'm curious too, kind of taking it into the software route here. Why has surcharging become kind of what it is today, and something that software providers are maybe more interested in, or as a program that they can leverage, to offer their merchants and potentially profit from it as well. Why is that starting to kind of come to the forefront of the industry?
But I think there's a couple of reasons. So there are certainly business owners out there that are asking for it. So they're asking for a program, or what I would just call maybe generally as an alternative pricing program that they can leverage to contain costs. And so, because a lot of businesses now are driven off of some kind of business management software, some vertical SaaS solution, that's where they have to go take that request, right? It's no longer just an update on a terminal application. They now have to go to their business management partner and say, "Hey, I need your software to be able to support this, be able to reconcile this on a monthly basis with the fees included." And so that certainly their customers are asking for it, and that's what we're hearing from our partners, that um, they need to do the work on their end so that their customers can get access to this. I also think that it's could be healthy for the industry. One of the challenges in these programs is ensuring that it's done properly. There's reasons for that. So card brand rules and um, state and local laws prohibit um, certain activities from the merchant when it comes to accepting these kinds of payments. And I think that what can be very good for a small business is if their software provider takes that on and delivers an ecosystem that is less likely to produce a non-compliant outcome. I'm not trying to give you word salad. I'm trying to say, like, if you control the workflows in the business and what's being presented to the consumer, because that's all done through software, that software can then be very thoughtful ahead of time as to what those workflows are and what that disclosure looks like to help the merchant stay compliant. Um, and then the last one, I think that, we would be remiss if we didn't say that one of the drivers here is that when a merchant goes into one of these programs, they do become a bit less price sensitive on what they're paying for their merchant processing. And so I do think in some segments, a software provider can see a margin opportunity if they implement this, or they can charge for the program itself and say, well, if you want to use this alternative pricing, you have to turn on certain features, like dual pricing is an example. Um, you would want to have your entire inventory in the software have two prices. So it's not just two prices on the store shelf or on the menu board above the register. It's, throughout the software, you're maintaining a database with two prices, either for dual pricing, and um, if you're implementing cash discounting, you're going to do that in the software. And so you might say, for those features, we're going to charge a little extra and create some margin there to deliver that.
That's great. Um, yeah, you mentioned some things about compliance, which we're gonna get into a little bit here, and I think this question potentially could kind of segue us there. But are there any like big misconceptions that software providers tend to have when it comes to surcharging versus a discount-based pricing model? Um, like I said, I think that might segue us into the compliance bit. But what are the biggest misconceptions ultimately from software providers?
I mean, Chris, what we've seen is, I think we've seen some software providers creating global features within their software that allows somebody to add a surcharge. That's not a surcharge. They're not doing it properly. So I think what happens is they want to create flexibility in their software to say like, hey, you can add a fee and make it really easy, almost like it's really easy to add a discount, but it's like a negative discount. And then what happens is a merchant says, well, I just came from my favorite taco shop and they surcharged me 3%. So I'm going to go into my software and I'm going to put essentially a negative 3% discount or a markup of 3%. And I'm going to tell my staff that when they ring somebody up and they're going to present a card to apply that fee. And right there now they've used what would have been just tools in the software for managing their business, and they've created a non-compliant scenario. We've seen some of that. I also think that software providers tend to simplify this to not acknowledge that certain states have certain rules, and so they don't quite understand this. When you did the intro to the podcast, you talked about simplification of the payments industry. Some of the complexity here is not of our choosing. It's the regulatory or the legal environment that we operate in, and different states have decided to protect consumers or business owners in different ways, and that creates a little bit of complexity that you can't avoid. And so that's where we have to try to instruct them to sort that out.
Yeah, and that that perfectly segues us to this next piece, which I'm hoping, Chris, you can provide some insight. Based on Matt's response, these programs I don't think are legal everywhere, but kind of highlight where these models are legal and where they're not.
I think, I mean, just to back up on one of Matt's points on just in terms of the software providers sometimes trying to make it as simple as let me just create a field to um, allow this customer to go up or down for that matter. And those fields, such as service fee fields, in other providers, I think they're used um, in a manner that lends to non-compliance. And back to our original chat about what does compliance look like? Disclosure is a big part of that. So as a consumer, if you're walking into it knowing that I've got a choice, I've got a dual pricing choice, I've got cash on me, I've got a card, I can make a choice. That's what we want to see is that the consumer is being disclosed correctly, not it being a choice of upcharge at the point of sale. Um, in terms of states, it's a very complex situation. We've got we've got states that are outright saying, no, surcharging, very flat, very simple. Um, Massachusetts, Maine, states that are just outright saying we're not gonna accept it. That's actually pretty easy to deal with. Any ISV can code to that during the checkout process. I think the complexity is in some of those states that uh, we're going to limit it to cost of acceptance. Colorado is one of the complex ones. Cost of acceptance or this cap. It's either or scenario. We're starting to see some states adopt. So that's where it gets a little bit more complex. That's where we can actually add some value whenever we're sitting down during our integrations process with with an ISP, saying, "Hey, look, here's the rule set. Here's what this looks like. Here's where this design should go," and we can add kind of a very high level consultative approach with that. So,
Yeah,
Yeah, no, that's
one of the things that we do really well, Steve, is in a lot of cases we help our vertical SaaS partners go to market. So we'll market and sell for them out of a specialized team that does this. And a lot of software providers want the control to go to market on their own. One of the benefits is if you're, and I'm thinking of one of our largest partners, they're not payments experts. They don't want to be payments experts. Their software does a lot of very nuanced things, interacting with insurance carriers and OEMs and all sorts of really complicated things. I would say their software does many things, and of those, helping collect a consumer payment is one of them. And so they're not specializing on it. They also want to have a surcharge program. So they want to launch, they have launched a compliant surcharge program. The nice thing about that model that we have is in that case, it makes perfect sense for them to just use our salespeople, and our salespeople work with Chris's risk team, and they're trained on this kind of stuff. So if an opportunity comes in with that software provider in Colorado, they have a good idea of what's going to fly and not going to fly, and we're able to kind of bridge the gap. In some cases, our software partners are not in an ideal situation to become also payment experts, and that's where we can help a lot. And of course, we have tools, boarding tools, and things to help make sure that we can catch things as they come in. But sometimes it's nice to have a trusted professional in the space.
yeah, no, absolutely. I mean, from my level with marketing and everything with the compliance of surcharging and these programs, really leading with education. I think that's the most critical thing. And it's, again, why we started this podcast. It's why we write all the blogs that we write. Very critical to have that educational background with it, and a consultative partner that's going to, really guide you along that way, because it's complex. There's a lot going on with it. With that said, let's jump into some of the implications for software providers a little bit more. What role should, a SaaS platform play in enabling or managing these pricing models, for their merchants? We've highlighted a little bit of this already, but want to kind of dive into it a little bit deeper here.
Um, I think that first and foremost, um, we were just talking about education. So I think it would be best for a vertical SaaS solution provider to recognize that this is not just about turning on a field at checkout or turning off a field. That they need to be thinking about educating that merchant on what compliance looks like. If they don't, they run the risk of fines, and we won't get into a lot of the details on that here, but there is the risk of a small business being levied a fine for noncompliance. The card ecosystem is looking to ensure that cardholders are treated fairly and correctly by merchants, regardless of what part of what industry they're in. And so I think a vertical SaaS provider needs to recognize, okay, so I'm gonna open up this program for my customers. It's gonna help them. It'll help me. I'll be more competitive. And now I need to work with my payment processing partner to put together the education that is needed, the checks and balances. I'm thinking things like blog articles on the vertical SaaS provider's website, FAQs on their website that are talking about how to use their software in a compliant manner. And that's where, Chris was talking about where we can advise on this kind of thing. That's where we can come in and say, hey, these are the rules you're worried about. These are best practices. This is what is going to keep you in good standing, and not running afoul of the law. But then what that needs, it's good to educate the partner, but the partner needs to turn around and get that word out to their customers. Because ultimately what we're looking for is a happy customer that doesn't have challenges that then reverberate with the partner back through to, a sponsoring bank and back to a card network. And what we want is things to run smoothly. And that's really how, I mean, that's the original value proposition of the vertical SaaS, is that if you run your business on this software rather than spreadsheets or some other older solution, pen and paper, if you run on this software, you'll be more efficient, you'll create less errors, and compliance is really just the avoidance of some errors that can be costly.
Yeah, anything you want to kind of follow up there with, Chris?
I
The
think it,
next question I had on my list here is,
I think it really comes down to that logic tree. When that ISV or that partner is looking at creating that experience, are they considering all of the different paths that transaction can go down based on the selected payment type of that customer, or the program that software provider is trying to implement, making sure that you've got a logic tree that's consideration of where the customer's at, that's fully disclosing to the customer as they go through the transaction. That's where we can step in and kind of take a look at that and offer that consultative approach to it.
yeah, no, that's great. Yeah, I think those are really helpful points. And kind of to start off this micro series of surcharging, we are going to wrap up this first part. I think that's a good kind of breaking point until we get into the next part here for episode, or technically part 2 of this one episode. But really appreciate the time today and kind of just walking us through this. I think there's a lot to cover in this next piece here, which we'll really be getting into, how a SaaS platform can better implement these. We highlighted kind of the details, broke the programs down a little bit, but how they can better implement these and then actually generate revenue from them as well in a safe and compliant way. With that said, we're going to wrap up Payment Pulse for today. Listeners, appreciate you taking the time to listen to us today. Drop any questions, any comments, in the chat. We'd love to hear what you have to say and be a part of this conversation as well. And that way we can address any of your specific questions more directly also. But again, thank you for listening. Thanks, Matt and Chris, for the time. We will see you very soon.